good morning and welcome to the Business Owners Strategy Forum. My name is Matt Murphy, for those that don't know me. I'm the Managing Director of Prime Accounting and Business Advisory, and we're bringing to you this forum that we've done for the last 10 or 11 weeks, and it's been very well received, and we've obviously covered a lot of ground and a lot of topic over the last sort of 10 weeks, and this will be our 11th week. And as we've indicated, we've done this because we wanted to make sure that we're presenting information through some difficult times that we're going through as business owners and in business, and navigating through the complexity of that. So this is very much around sort of providing relevant, timely content to you as running businesses and business owners. So today is no exception. We've got Matt Smith today, who's one of our partners at Prime Accounting Business Advisory, and myself, that's going to talk about sort of year-end planning, and also thinking about planning beyond not just 2021, but beyond 2021 as well. Just in terms of, the topics that we have covered historically in this period of time, is that this is on screen there, many topics that we've covered off, and a lot of information, a lot of quality information that we've been able to present. And we're going to continue to do so, but we're changing the format slightly in terms of how we're going to continue on with these forum, that we'll typically have probably one presenter. The reason we had multiple presenters for the last 10 weeks is because we wanted to deliver as much content as in a shorter period of time, especially because there was just so much sort of support that was needed going through sort of COVID-19 stuff. So from that point of view, we're now able to spend a little bit more time and go a bit more of a deeper dive on some of the topics that we're going to cover in the future. And we've got some great presenters lined up in the next few weeks as well. So looking forward to presenting with those people. But I'm going to start with today. So today is very much around year-end planning, as I said. So we're coming up towards the end of the financial year, and we need to think about, in our businesses, what we need to do. So we're going to focus a little bit on the tax planning element of it, but also starting to think about planning for not only the next 12 months, but beyond that, given that we've got an opportunity, because we've obviously got a significant change in our worlds, and we want to make sure that we're ready and prepared for that. So I'm going to get Matt to present on some of this year-end financial stuff, and with a strong tax element associated with that. As per usual, we've got a question and answer button there. So if you've got any questions when Matt or I are presenting, please feel free to write those in the question and answer box, and we'll be able to cover those off at the end of the session today. So I'm going to stop sharing for a minute, and I'm going to let Matt Smith share his screen in terms of some of the points that he's going to cover across. So thanks, Matt. I know that you, as we all are, speaking to a lot of business owners and businesses at the moment, as we normally do at this time of year, thinking about what can we do and what should we be doing as responsible business owners between now and the end of the financial year, being 30 June. So I've sort of asked you to present some of the topics and some of the information that you typically go through with your businesses and business owners, at this time of year. So I know that a number of topics you want to cover off on for today.
Thanks, Matt, and hi everyone. Hard to believe we're sort of 1 month from the end of another financial year, but it's definitely been an unusual one to say the least. So look, as Matt said, we've been sort of starting the process over the last couple of weeks of talking to our clients in terms of making sure we're completely prepared for end of financial year. And in particular, if there are any items that we need to be sort of considering at the moment to make sure that we're getting the most efficient tax outcome that we can. So naturally, if you're paying tax, you're making money. So that's a good sign. But we don't want to be paying any more tax than we need to be paying. So what we thought we'd do today is just cover off on a few of those key items that can help to I guess ensure that best outcome. So I guess the most important piece, and we sort of bang on about it a little bit, is the fact that we can't do any planning unless we know where we're currently at. So it's really important that we have up-to-date financials. We're coming to the end of May. So, hopefully by next week, we sort of have year-to-date financials that are accurate and that reflect our position as at the end of May, so that we can start to have a think about what the likely tax position is as it currently stands, and in turn whether there are any items that we can, or any actions that we can implement between now and 30 June to I guess minimise that position. The first one that we normally talk about is superannuation, and so for business owners, depending on where the income position is, hopefully we're sitting in a profitable position, and we have some flexibility in and around our cash flow to allow us to make some extra super contributions if we haven't used up our full concessional caps. So the concessional cap on an individual basis at the moment is still at 25,000. However, as of last year, there was an implemented option that you can accumulate any concessional caps that you haven't used. So that started in FY19, and so any FY19 unused concessional contributions can actually be added to this year, and therefore you've got 50,000 over the 2 years. So that's the first.
Just for clarity around that, what you're saying is that if you contributed 20,000 last year in 2019, so you got $5,000 left on your cap, then you can add that 5,000 to this year's contributions, which means you've got a concessional cap for 2020 of 30,000.
Spot on.
Yeah. Cool.
Yep. So please reach out to your advisors in respect of that, and in particular, our role within accounting and business advisory is to talk to you about the tax implications of that, but you also need to be considering your overall strategy from a wealth perspective as well. So it's important that you're talking to your wealth advisors in as part of that conversation.
Yeah, and the other element to that, what you spoke about before too, Matt, is that there's probably three angles that you need to think about. You need to think about cash, about whether you can actually afford this from a cash flow perspective in your business. You need to think about it from a tax deductibility perspective, and to minimise your tax appropriately, and then looking at it from a personal perspective on your wealth accumulation strategy. So there's probably three angles that you need to consider before making a decision on how much superannuation you need to put into your own personal super fund. Absolutely.
So the next one we normally cover off on is bad debts. Now, no one really likes. Hopefully, we don't have any of these, but it's important to at least consider what we've got sitting on our debtors ledger, at this time of year, because there's often a tax and a GST impact in and around holding these. If we're fairly confident, and based on our bad debt recovery process, if we're fairly confident that we've exhausted all options to recover debtors, then we should be considering writing them off at 30 June, because we don't want to be paying tax or GST on any invoices that we're not going to receive.
And this is obviously based around the fact that if you run an accruals accounting system rather than a cash accounting system, Matt. So if you're running an accruals accounting system, that means that you're including debtors in your revenue, which means that it will be included in your profit, which obviously then that's how you pay tax from that point of view. So you don't want to be paying any tax on something you're not going to collect, or you've got a very low chance of collecting. So that's why it's important to do the review before the end of the financial year.
100%. So probably historically not as big a ticket item, but this year it's probably, given COVID and some of the stimulus that's been presented, the asset write-off and depreciation item is potentially a bigger ticket item this year. We know that up until 30 June, there's been an extension to the instant asset write-off from 30,000 up to 150,000. We've covered off on that previously. and naturally that has an impact if you're in the SBE concessions in and around your pool balance and what we can write off there. So I guess the point we sort of try and make to clients in respect of this one is, don't go and spend $1 to get 30 cents or 40 cents back. But if you are planning a purchase, be it a vehicle or some sort of machinery, whatever it is to, in the ongoing process of managing your business, if you are sort of projecting that you'll need to spend some money on assets over the next sort of 6 to 12 months, it might be worth considering bringing that purchase forward to before 30 June to obviously access these tax benefits. So it's important to remember that those assets need to be installed and ready for use. So no point getting an invoice on the 30th or 29th of June if you don't have access to the asset, because your deduction may be not be allowed at that point. So that's why we're sort of raising it now with a month up our sleeve so that we can plan for that.
And just to be clear on the impact of doing that, is that typically assets get written off over the life of over their life fundamentally, which means that you only get a portion of the cost of the asset every year off your revenue to reduce your profit. Okay, so whereas what these accelerated provisions do is to write off the whole value of the asset in one go in the year in which it was installed ready for use. And so that's why it's important to look at this, because if you're in a profitable situation and you want to reduce tax that you're paying for and the asset, as Matt says, is required, it may be relevant to do it now before the 30th of June than after June, because you'll get the tax deduction this year in entirety up until those particular limits, as opposed to next year or on a drip feed basis over the life of the asset. So that's why it's important to think about this stuff now, but in lieu of the strategy that you would have in your business. So you just don't do things for the sake of doing them to get to save tax. You do them because that's strategically the right way to go, is the point that we're making.
Spot on. And in addition to that, Matt, you might still have some of these assets financed. So the fact you don't have to be buying these assets with cash, you as long as the finance is structured the right way, you can still get the full deduction now, but you may still be paying that asset off over a number of years from a cash flow perspective.
Cool.
Okay, so the next thing that we generally have a look at is our loan position. So Division 7A loans is it's obviously the legislative term, and effectively what Div 7A is where loans from a company where the company's paying sort of 27.5 cents or 30 cents in the dollar on its profit have come out to associates, be it directors or shareholders, and that potentially they're on a higher tax bracket. So I guess we need to understand whether there's any of those loans in place and whether there's any minimum repayments that are required, because to not make our minimum repayments can have a really negative tax outcome. And so it's just understanding, do we have the cash personally to tip back in to cover these repayments, or do we need to consider a dividend? And I guess if we're in the dividend strategy path, do we have enough franking credits in our franking account to be able to pay these dividends? And if we don't, we may need to prepay some tax to allow us to be able to do that, so that we don't have a negative tax outcome.
Cool. The just with the Division 7A loans, just from a simplistic perspective, that it's about how money comes out of a company, so or a trust, but predominantly a company. So, for example, a business owner can take money out of that company via paying wages, paying a dividend, or loaning it out. And so what we're really talking about there is where money's being loaned out of a company to the individual shareholders of the organisation. That's where these provisions actually apply. And what we need to consider is how we're going to manage that, because there's provisions in the legislation that require us to actually deal with those as loans. So that means that we have to either pay them back, as Matt said, declare a dividend, or whether we need to even do that at all, given the provisions themselves. So that's obviously what we need to assess before 30 June.
Absolutely. And so the next point there, with respect to trust distribution minutes. So many years ago, it was sort of a common practice that 30 June would pass, and whenever the tax return was completed for a trust, we would sort of work out the best tax strategy and sort of do our distribution minutes after the fact. The ATO came down a few years ago on that, and I guess demanded that practice had to stop. And so, it's really important now, more important than ever, that we're making sure we're getting those trust distribution minutes completed prior to 30 June, which in and of itself is not a difficult process. But I guess to be able to do that and ensure we are being as efficient from a tax perspective as possible, we need to understand, back to the start, of the considerations. Where are we at? How much profit is there to distribute? Who are the beneficiaries that we can distribute to? What are their marginal rates? And it can have a pretty significant impact on the tax that we're paying at the end of the day. I have a live example of last year. We had a trust that was that had about $1 million worth of profit. It was probably a one-off profit that was going to be that high. We weren't foreseeing that FY20 was going to be as high as that. And so we sort of had 3 main adult beneficiaries in our view that we could use in that year. And so what we decided to do was to distribute up to the top marginal rate. So, 180, about half of the profit to the 3 individuals, and to distribute to a bucket company or a dump company for the balance as at 30 June, and cap that tax for the other half at 27.5 cents in the dollar. So Matt, I know you sort of wanted to just touch on what is a dump company. So effectively, it's a company that is so we can distribute to individuals out of trusts, or we can distribute to other entities. And in this case, we used a company. A company, has a capped tax rate. But going back to the Division 7A loans that we talked about a minute ago, there are some restrictions on what has to happen if we are distributing back to a company. And so, if the cash is not going to flow through to the company, we need to have a pretty clear understanding. We might fall foul of a Division 7A UPE situation there, an unpaid present entitlement. So we needed to have a strategy, but effectively, as long as we were going to be clearing that UPE via a further dividend in the following year, we were able to effectively ensure that we weren't paying top marginal rate on that extra $500,000, which by spacing it out to the following year where the income was a lot less, we were able to save significant amounts of tax.
So really you can get into quite technical detail around this sort of type stuff, because there is a lot of technical things to think about, and it's hard to sort of convey that. But I think the message that you're talking about there is that you're using strategies to even out the tax that you would pay by being able to stretch them out over a 2-year period or a 3-year period, rather than just in 1 year where you have some abnormality. So therefore, you end up having a timing benefit, but you also have a permanent tax reduction because that's kind of fair and reasonable to do it this particular way. So we're not really advocating anything that's not inside the law. It's just good tax strategies to be able to minimise the amount of tax that you pay, and you get, as long as we're thinking about it from a strategic perspective as well. So I think that's the point.
Yeah, absolutely.
Thanks.
And then I guess the thing that underpins the whole process is cash flow. It's a commonly used phrase, cash is king. Everyone's heard that phrase, but I guess that really that dictates how much flexibility we do have in some of these things. And so if we know that we do have some tax to pay at some stage in the future, we can plan for it. So, likely if we're talking 30 June 2020, which we're coming up to, the tax, the ultimate top-up tax for this is if it's a first year or if it's it's a growth business, is not going to be payable until sort of March or May of 2021. So we've got some time there. I guess it's also important to know that once we do lodge those returns in the future, we've also then, will fall into the PAYG system, and the ATO will expect us to be paying those. So you kind of get a bit of a double hit there at the end of next year. So, it's important not to get caught short and to make sure we're planning for that cash flow of the tax.
Yeah, it's a really good point, man. I think I've had this conversation probably over 1,000 times with business owners in terms of this particular issue, and because, obviously we're paying tax on the profits that were made in this financial year, so the end of 2020. And we may not lodge our tax returns until March of 2021, for example, because that's, or even May. And so the ATO didn't know that we actually had that profit for this year. And it could be either a growth year, as you say, or the first time that you've actually lodged a return. So they now are aware that you're actually making money. They assume that you're going to make the same amount of money again in the 2021 year. And so to do a catch-up, what they will do is they'll actually issue a PAYG lump sum invoice to pay usually a month or two after you've just paid your 2020 tax return. So you end up paying 2 years worth of tax in the space of about 2 months. So we just have to be mindful of that in terms of, cash flow management to ensure that we are planning for it. So cash flow planning is in two aspects, as Matt indicated. One is that, can we afford to spend some money on things before the end of the financial year that might reduce tax? That's a cash flow consideration. But then once we've actually got the optimum amount of tax that we're payable, making sure that we're factoring those in our cash flow planning for the future and taking into consideration the PAYG implications of it as well. So it should be factored into your quarterly or yearly amounts. And that's probably the thing that catches a lot of people short, and actually can cause some significant grief to businesses, and some businesses can hit the wall because of it too if they haven't thought about it. That would be your experience, Matt?
Absolutely. It's important to get you've got the advantage of having the cash for an extra 12 months, which you might be able to utilise for a growth strategy or utilise within the business. But it's just important we've got that plan to be able to pull it back out as required at the right time.
Cool.
So look, that's probably the main items that I wanted to cover off on today, and there are a few other bits and pieces. But please reach out. It's a good time just to take stock, reflect, and sort of have a think about what's gone by this year, what's worked, what hasn't, and I guess segue into what Matt's about to talk about is the bigger picture of what is the strategy for next year and the future years, and be having a bit of a think about that now as well.
Thanks, Matt. I think before I jump into that, there's just a couple of things that I wanted to also make mention of, is that we've had conversations with business owners about. Think about the revenue that you've got and about the revenue recognition. So make sure that you bring to account or deferring revenue into your businesses that may not necessarily be deemed to be revenue that you need to pay tax on. So you just got to be mindful of that. So there's deferral mechanisms around that, and also planning individually around some of the tax deductions you might want to get as well. So, and I just wanted to make sure that we're sort of covering off on those particular points, Matt, from that perspective. Is there anything else from that point of view that you wanted to mention? And also there's probably a couple of quick questions that I wanted to cover up before I just jumped into what I was going to talk about.
No, probably the only other one, probably rather than at a business level, is the individual level. A lot of us have been sort of working from home, and there's been a lot of media coverage in and around the ATO's view on what that means. So what the ATO have said is they've upped the cents per hour rate, which is kind of a catch-all rate. So that is to cover electricity, it is to cover home office equipment, all those sorts of items. And so, still probably the best method is going to be an actual cost method and an appropriate apportionment of what the business use of that is. So if you've gone out and you've bought new monitors and you've bought, a heap of equipment to help you to work from home, likely the actual method is still going to be the best method for you to apply. The 80-cent method is if you haven't kept fantastic records or it's a better result from you that you've been working, 40 hours a week from home for the last sort of 10 or 12 weeks with another 4 weeks to go before the end of the financial year, that 80 cents per hour method may be the best result for you. So it's just worth, again, having a chat to your advisor and sort of considering that option.
Cool. And there was a question that got asked last session as well around the $150,000 write-off, I think from Greg, just in terms of some of the assets that you can claim for that in terms of, and I think we were talking about digital transformation in organisations, so websites and that sort of type thing. Have you got any further thought around that?
Yeah, so look, I think that being an asset that, and as long as you're in the sort of the SBE frame,
small business
exemptions. Yeah. Look, it's likely that you would get an instant asset write-off for any of those sort of costs in the lead up to 30 June.
Yeah, and just a quick question too that we've got from Mark. So that with the 150K write-off, if the asset was bought within the tax year but prior to the announcement, does the company still get the full write-off for the year?
No, so that rule came in as of the 12th of March. So your asset regarding that 150 specific write-off would need to be purchased after that time. However, if we are using the pooling system, there still may be an ability to write off that asset, in full before the end of the financial year. So we would just have to have a bit of a look at it.
Yeah. Cool. Thanks, Matt. And look, with all of this stuff, obviously we're giving overarching advice and really you should reach out to your advisors in relation to this stuff because, we're talking broad concepts and there's a lot of devil in the detail when it comes to tax law, as you can understand. So therefore, that's my overarching disclaimer for today's conversation is like it is every week, is that, we're providing generic and general advice to people, but their own specific circumstances need to be taken into consideration because there's a lot of complexity in a lot of, not only the law, but also making sure that it fits inside your strategy. Cool. So as Matt indicated, obviously we're thinking about, between now and the end of the financial year, okay, and making sure that we're prepared for the end of the financial year. But it also gives us a great opportunity to start to think about the next financial year and where we're at with that. And so what we've spoken about in the last couple of sessions and probably over the last 10 weeks is planning, because obviously we're going through, some really interesting, difficult times at the moment. And we want to make sure that we're going to plan to come out the other end of that in a very thriving basis. But what I want to make sure is that people don't just lose sight of, the prize, okay? And yes, we've spoken about the next 12 months and planning for that and doing the cash flow forecasting and the revenue forecasting for that in uncertain times and how you do that. And so that's really, really important. But what I want to make sure that we don't do, and when we've got this great opportunity where there's kind of almost like a pause or a pivot that we've got right now in our lives where we can start to say, well, what is it that we actually really want? And so the challenge for us as business owners is building a scalable and sustainable business model in a rapidly changing world. And obviously we're in a massively rapidly changing world right now. And so we need to navigate through the complexities. But the things that haven't changed, right, is what we did. We had a business dream. So this is something that I talk to many people about, and a few people that are online right now know that I focus on this, because the decisions that we should be making should be put through certain lenses. Now, the major reason why I do this particular job and why it's attracted me into the profession is because I believe that business owners are courageous, and I like to support them as much as I possibly can because they've got the guts to have a go to get into business. And typically we have a dream when we go into business, and I'm no different to that given that, I'm a business owner like everybody online, and so is Matt, is that we have a dream when we go into business. And so that hasn't changed, even though we've got all the things that are going on at the moment. we still need to think about that and need to assess how we're going against the dream and whether we're achieving what we wanted to achieve. So there's typically 6 reasons why people go into business and remain in business over a period of time, and they can change as you continue on. But these are the 6 reasons that I've come up with by, probably interviewing thousands of business owners over my career, is that, there's financial security and independence. A lot of people go into business, obviously, because they need to make money to sustain their livelihoods and their families. And that's a driver. And if you've ever studied Maslow's hierarchy of needs, it's kind of like the food and shelter, bottom of the pyramid stuff. But then also, people go into business because they have a creative entrepreneurial flair. They like to build things and create things, and that's the motivating and driving force. That some of them have got a pursuit of excellence, that they like to strive for excellence and to better themselves and to better their business and their lives. They go into it for work-life balance reasons, so that they want to, they don't want to just be working for somebody else where they get dictated to in terms of how they're going to go and live their life. The funny part about work-life balance, if in starting businesses, as we know, is that there's not a lot of work-life balance. It's just work balance because we're obviously trying to build our businesses. Control over destiny. We want to know that we're controlling what we can possibly achieve in our lives. Now, control is a bit of an illusion, as we know, but, sometimes we've got greater control over it than working for a larger organisation where, at some particular point in time, somebody can tap us on the shoulder and say, hey, you're now redundant. So at least if you're the owner of the business, you've got more control over that, but other factors you have to take into consideration. And the final one is legacy, that we like to build things so they have a life of its own, they continue on, that whatever we're built will support the lives of families of our team and also for our clients and our suppliers and customers. So these are sort of the motivating factors. Now, if you've ever worked with me, you know that I'm very focused on this because we went into business for these reasons. Generally, we gravitate towards 2 of these at any given point in time, and they can change over your life of your business. And so when we sit there and we start to analyse this, I get people to start to say, well, okay, why did you go into business in the first place? Rate yourself, rank these 1 to 5 and rank them as you see them today. Then what we do is you'll come up with a list of sort of 1 to 6, in terms of the order of priority of those from the ranking. And then you start to get a sense of what's important to you. And so, work-life balance might be something that's hugely important for you. And so if you're currently ranked, so that's a ranking that's, very, very important. And then I get people to rank themselves around how well they're actually got work-life balance. And they might say, I've only got a 2 out of 5 because I've actually got terrible work-life balance. It means we need to put a strategic plan around that because once again, you went into business for a reason. That's part of the reason that you go into business is for that work-life balance. That's important to you. And there's often times where business owners will come to me and they say, I've got a great opportunity to go and expand my business internationally. And I go, that's awesome. And I can do the numbers and work out whether that's the right thing to do from a making money perspective and a profitability. But I'll often ask the business owner, why did you go into business in the first place? And they say one of the key drivers to that might be work-life balance. And I'll say, well, you know that you're probably going to end up on a plane for the next 2 years of your life if you're going to execute this strategy properly to be international. Now they still might make the decision that the sacrifice is worth it. But what's important is to ensure that they put it through this lens. So what I'm encouraging everybody to do from this conversation is when they're looking at the next 12 months, what they need to do is look beyond to say, I really want to make sure that I achieve why I went into business in the first place and the outcomes that I want. And then the plan for the next 12 months should be working towards that ultimate goal. So, and the good exercise with this is that it starts to give us a new lens to make decisions. So it's a lens to make a decision around saying, well, actually, you know what? I don't want to expand my business internationally because I do value work-life balance. So therefore, I'm not going to make that decision. I'll make a different decision to make money or grow the organisation. So, you can start to see once you actually put that through a particular lens. Because this is kind of the ultimate goal. And some people call this retirement. I just call this great living. And really, this is what we're ultimately trying to do, is doing what we want, when we want, in the manner you want, with whom you want. So once again, I get people to start to rank themselves and rate themselves against each one of these particular points, because we agree that you're living a pretty good life if you're doing what you want, when you want, the manner you want, with whom you want. So we get to start to assess that. And once again, this is a great opportunity while we're going through this difficult times to work out whether we should be, whether to rank ourselves against these particular things, because you might say, well, actually, I am doing what I want. I don't necessarily do it when I want. So I'd like to, have more flexibility of time and freedom on time. I do it in a manner that I want. Maybe, do I get to turn left on a plane, or do I have to go and sit in cattle class? And you may be doing it with whom you want. So, for example, you look at the people around you and say, yeah, these are the people that I want to have around me, or not. And so you start to assess and rank yourself from that. And if you're not ranking highly on some of those things, then now is the time to start to plan about how you could possibly rank better in that. And so once again, this is just a reflection time, and it's something that becomes hugely powerful for people to then start to work out, am I achieving what I want to achieve? And so this is the question that I'm going to challenge everybody with today, is that have you fully achieved your dream, and is your business by design? And the reason why I talk about business by design is because oftentimes we get into business by default, meaning by default, which means that the business itself dictates how we live in our life, meaning that the clients, the customers, the suppliers, your team, we're starting to become reactionary to everybody else's wishes, and we put ourselves as business owners sometimes last, and therefore the business becomes a bit of a jail for us, a bit of a prison for us. So what we're trying to do is release ourselves from that and free ourselves up. And that's why, when I work with business owners, I want to make sure that we're being true to ourselves, because going back to that first point that I made, you've got the guts to have a go, and you should be rewarded for that as a business owner, because it's not an easy thing to do. And that's why the decisions we should make should come into this lens. Okay, so this is why I really want everybody to challenge themselves around thinking about this decision-making process. And when we do this with our clients, because we do this in workshops and we do this in sessions, and we constantly are working with them, we're pushing them on those particular points, because it actually means we're driving and developing better businesses that are going to serve our personal lives better as well, and our families better. And so this is another challenge for you, is that, in terms of your business by design, you need to think about your business life, okay? And that's like your personal life in your business. The numbers, is it producing the profit, the cash, the value that you want to get from the business, the types of products and services you're offering to the marketplace, and whether that's sort of something that you feel proud of and you really enjoy doing. The culture of your organization, we lead as leaders the culture. And I've spoken about that in other sessions, where from a leadership perspective, the culture of the business really will be a reflection of you as a business leader. And the clients that are teed it up, because sometimes great clients turn up to our businesses, sometimes they don't. And this is where we need to start to assess that, to ensure that, we're surrounded once again by the people that we want to serve and want to support. And that's hugely important as well. And so really what I'm talking about today is to get you guys and girls to reflect on where you're at right now, and coming into the end of the year, starting to set your forecasts and budgets for the next 12 months to determine where you want to get to. And this is about designing your life, like, your business life, how many days you want to work, how many holidays you want to have, what role do you want to play at work, who do you want to be working with. This is down to personal stuff as well. Okay, because you've got the right to do that because you're the business owner. Okay, so what I want you to start to think about, if you haven't already done this exercise with me, so you can go and do it, is to think about the strategy. Okay, think about your destination. So the destination is the vision, where the business wants to go, where you want to get to cover off on those things we spoke about today. we need to put in place a strategy, which is the map, okay? And the map's really important, okay? Because unless we don't have the map, we really don't know the direction in which we want to go into. And a lot of you have heard my analogies where I talk about a roadmap, is the strategy. And then the road signs are our data, okay? So we need to make sure that we've got good financial information at our fingertips to be able to see what road we're traveling on to work out if we're on the map or not. Now, Matt said that earlier today is his first point, even when we're thinking about tax planning before year end, is knowing your numbers, okay? So knowing your numbers is hugely important to ensure that you're going to end up with the ability to see whether you're on the right map or not, whether you're on the right road. Because you could be driving down the road, okay, and be on a different road than what you thought you were going to be on. And then we need to think from a strategic perspective how to get back on that road again. But knowing your numbers is important because you start the map from a starting point that may not necessarily be the right starting point either, because you've actually don't know your numbers well enough. So it's really important to have that sort of the destination, the strategy and the data in place to ensure that you can measure and monitor this stuff. And that's why we do this thing called the one-page plan, okay? Because the one-page plan gives you that sort of sense of, where I want to get to in the next 3, 5, 10 years of my life, why I'm doing it, the values in the culture that we want to have in the organisation and what we're sort of promising to our clients and customers. And from that, we then go back into sort of, what's the next 12 months look like? So you can see from this slide here that you've got the ability to have a look at what the next 12 months looks like. Okay, this is our planning for the next 12 months, but it should be aligned with our ultimate goal. Because if it's not, we need to think about that. So once again, just using tools and techniques to ensure that our next 12 months planning is in line with, the things that we spoke about, going all the way back to, the dream of going to business. So that's why I wanted to cover off on that today, because we're looking at it from the perspective of, okay, we're coming into the end of financial year. What are all the responsible things we need to do as business owners? And then we need to look to next year and beyond to make sure the plans we're setting up for next year are going to allow us to get towards our ultimate goal, which is the reasons we went into business in the first place. So that kind of brings the whole thing together from that point of view. So hopefully people got some value out of this particular thing and gives people, time to reflect and consider and think about, what they want to do moving forward, okay? And focusing on what they want to get. And we've got this perfect time to be able to do that. So yeah, that's kind of something that I just wanted to talk about today. Matt, have you got anything to add in terms of that?
No, Matt, just that I noticed that there was a question that had come on there requesting to see if the attendees could get a copy of that one-page plan.
Yeah. And so look, all our slides are available from that perspective. And yes, you can get that. And look, because we are very open and liberal when it comes to sharing content and information. Books, I'm a published author on all this, on the topic of business growth and development. So, I'm very comfortable in publishing sort of information and data because it's out there in the marketplace. The trick though is ensuring that you implement it, ensuring that you do it, ensuring that you keep it. So it's a discipline and accountability. So what we're providing to you is a structure today, but really it's about discipline and accountability. And that's why, we spend a lot of our time coaching, mentoring, managing chair, roles or board advisory roles to ensure that we can actually help our business owners achieve that particular thing. So happy to give the content. It'll be in our slide. But once again, we, if you need help and assistance, just like Matt said about, the tax planning, we're here to do that. But, we're not here to sell. We're here to deliver support and content to our clients and businesses in general, because that's a community that we support. But we also are here to try and help where we possibly can in any different ways. So I think that's fair from that perspective. Does that resonate with you, Matt, in terms of that?
Yep, absolutely.
Yeah. So look, that covers off on today's content. Hopefully we all got some value out of that. And now it's about doing something with that. Okay. So otherwise for the last sort of 45 minutes. And so now it's about, okay, implementation. And all the things that we do is very much around implementation. How can we implement what we've actually learned and put in practice what we learn? Because, you know, the common theme for me continuously, people ask me, what's the difference between a mediocre business and a successful business? And I would say it's discipline. Okay, so it's the discipline of doing things that makes you great. Now, that's the stuff that's probably boring and not enjoyable, but that's what it takes. And I spend a lot of time in this particular space of trying to help people achieve those particular things. So it comes up time and time again, and you know, it creates the biggest difference. So thank you all for listening today. Matt, thank you so much for your time. I've got my person that asks me lots of great questions. Who's a mate of mine that likes to ask me, and I'm just reading it to sanitize to make sure there's nothing wrong in relation to that. It's a question around, I don't know, Matt, if you can actually decipher that one and work out whether there's an answer to it or not.
I think, well, it's something that's been raised a fair bit lately. Michael, Matt's friend, has said, most of my cash flow has been going to Dan Murphy's lately. Do you think the ATO will give any special consideration to this problem? So it actually has been formally tabled to see whether there will be some FBT relief to help pubs and clubs and those, you know, businesses significantly affected. Mm-hmm. You know, to give them a bit of a leg up and to sort of encourage businesses to do a bit of that. So, you know, as it currently stands, alcohol is generally a no-no from a tax deductibility perspective, but that has definitely been discussed by the powers that be as to whether they do give some relief.
That's good. Thanks for that. Nice that you were able to turn that into a good conversation there, Matt. Once again, thank everyone for listening. Matt, great today. Really appreciate your input into the stuff we're talking about. And if anyone needs anything, you know where we are. We'd love to be able to help you. So thanks very much.